Hey, hi, it's Larry. Hi, it's Larry McDonald and Craig Shapiro. We're back again. Wanted to recap from our institutional chat. We work with institutional investors in 20 plus countries for the last 10 years at the Bear Trap Support. We host a conversation on Bloomberg, and Craig's hosting the Discord room as well with family offices and pension funds around the world. If you want to join us, contact Tatiana at thebeartrapsupport.com, Tatiana at thebeartrapsupport.com to get into the live conversation during the day. Craig, wanted to just recap this week. Steve Cohen speaking in Florida, and right now, and he's actually saying some of the things we've been talking about over the last 2 weeks. These ICE raids, the impact on the labor market, growth slowing, CFOs are not as confident. The uncertainty of the tariffs moves are impacting sentiment. Steve Cohen from Point 72, famous hedge fund manager, owner of the Mets, is saying that growth is going to slow to 1 to 1.5% in the second half. Pretty sharp slowdown relative to where we were.
Yeah, my old boss worked very closely with Steve for several years, and if there's one thing about Steve, he has a very, probably one of the best senses of the tape of anyone ever, right? And so for not necessarily the most macro guy, but if he's coming out and saying that he's very concerned, that means he's very set up to be very concerned. And I suspect.
Yeah, exactly. Good old Stevie.
So he's out there.
That's a great point. You know what? I was looking at it like, he's set up. So he's basically telling you that he's bearish and short because that's his book right now.
Absolutely, that's exactly right. And so, look, I think markets have been very strong, kind of up and through this week. We've been talking about that.
Yeah. So Craig, so you're running the chat room in the Discord. You're on the Bloomberg chat. You're talking to our different institutional clients. Just tell us what you do during the day. A client will mention something like today, the transports violently dislocating themselves relative to much of the market. And then you'll go back and forth and try to discern or discover color, deeper analysis with the clients. Is that what you're doing?
Yeah, absolutely. I mean, we have clients all around the world, hundreds of clients, institutions, family offices, family, wealth advisors. And so, typically that kind of news that comes out on, let's say, transports, we'll know a couple different guys in our chat that we know are great in transports. And so if we're seeing something, why are they moving? This company reported bad numbers, bad outlook, or this was a downgrade from, a well-known analyst. What do you think about that? And we can get some back and forth and really ascertain, what the buy side narrative is about why, transports are on.
Yeah. Do we have that chart, Jose? That chart's in BT6. It's the transports. There's a transports chart in there versus the XLF versus trans.
Yeah.
Buffett always said, trannies don't lie. The transports are incredible, right? Because you're a leading economic indicator in the transports. And as you can see here, we're seeing some clients looking at the financials on the short side, because if you think about it, the transports are the most economically sensitive sector. And at the same time, the financials seem to be in love with deregulation. I don't blame them, right? But you've got this deregulation love, right? Which has powered the financials, the Trump administration. But on the other side of the coin, you've got labor market stress from ICE, you've got tariffs, and you've got this slowdown, and that eventually probably makes the XLF catch up here with the transports. Is that what you're hearing from some of the clients?
Yeah, I think people are trying to start to sniff that out a bit. I think what we have is we had, maximum uncertainty in the summer into the election. And then as it became clear that Trump was going to win, we had the Trump bump, some euphoria and certainty about how great Trump and the Republican sweep was going to be for the economy, for small business, for deregulation, for tax cuts, and for everything. And that was the trade in through the end of the year and the early part of this year. And I think what we're now finding is uncertainty is back, right? I mean, Trump, has an agenda, but it's not clear how successful he'll be at getting that agenda done. The budget process is going on right now, very complicated with such a small majority in the House. The tariff policy is uncertain. The tax cuts, we're not really sure. So I think businesses and consumers now are starting to sit on their hands and wait. And this is something we've been talking about. We figured it would show up in some of the survey data over the course of the last few weeks. And it has. It showed up in the housing survey data. It showed up in the regional PMIs. And then today, we got a contractionary reading on the flash services PMI, the first one in, I think, 2.5 years. Services drive.
And remember, that's a survey. So the PMI, how is that determined? So they're going around to CFOs?
Yeah. Absolutely. So these surveys, whether they're regional or the national, the market PMI, which came out this morning, is a national survey that's going out to hundreds of accounts, hundreds of businesses around the country. And what are you seeing better or worse than last month? And so to see a contractionary reading for the services part of the economy is very concerning. And it really suggests that, folks are uncertain.
And one of the clients sent this chart. So one of the things I talked about it in our first book about Lehman Brothers, Colossal Failure of Common Sense, is a New York Times bestseller. It's in the top 20 all time at the CFA Institute. And I tell my wife once a month that, as a former Lehman trader, if we sell 1 million books, we'll break even on our Lehman stock, right? We'll break it. But Craig, one of the things that I remember in 2007, and I'm not saying this is 2008, but I've gone back in my career, and one of the things that traders talk about is, kind of tertiary financials leading the way. In other words, Synchrony is like your classic subprime lender, right? And so if your tertiary financials are rolling over relative to the financials, and that's the red is the XLF, it's not marked, but so in other words, you've got major big cap financials, and then you have the tertiary financials. And what we've seen in the 2022 economic drawdown, it wasn't, I guess technically it was almost a recession, but you can see there the financials got smoked, but Synchrony was getting hit way before the XLF, right? Craig, what are you hearing from clients this week? You're running the institutional chat. By the way, if someone wants to join us, it's Tatiana at thebeartrapsreport.com to get involved. You're coming out of a meeting. You're coming off a plane. You want to really, and you have risk on in the market. Join us in the chat. Reach out to us. Craig, what are clients saying here about this move in Synchrony?
Yeah, we pointed this out last week, and then we wrote about it in our weekly piece called "The One Idea." But consumer delinquencies on the rise. New York Fed report came out last week that showed a really big pickup in delinquencies for credit cards, for mortgages, for autos in the fourth quarter. And so, more and more Americans are finding themselves in the lower part of the K-shaped economy, increasingly strained, and credit card rates and borrowing rates are very high. We're talking about mid 20% credit card rates. And so consumer wallet shares are crimped. Default risk and potential delinquencies here, is a problem.
So Craig,
some of these banks, some of these
you're looking at that, and then you're talking about oil rates, like very mysterious move. Like think about inflation data has been surprising to the upside, and bonds are rallying. Like you got to think about that. So if the bonds are rallying violently with inflation data still coming in, Michigan today, the whole thing, there's all this inflation data, and bonds are rallying with the transports selling off and with oil rolling over. So those are your three kind of, how to listen when markets speak, right? Those are your three kind of big classic bellwethers. And then at the same time, subprime lending. So those four, food groups are pointing toward a slowdown, and I guess they would agree with Steve Cohen.
Yeah, I wrote this morning. The combination of the contraction in the services PMI and this hot reading in inflation expectations is a stagflationary shit sandwich. So, and I think that's what we're talking about. We're not talking about the 1970s style, stagflation. We're talking about a growth deceleration from 3.5%, GDP that we've been seeing down to. I don't know what the Atlanta Fed number has come in yet, but I suspect it's going to be, south of 2%. I think by the end of the quarter, we'll be, very close to flat for GDP in the first quarter, and likely continuing to get worse as we move through the year because of the fiscal contraction. But from DC. But then on inflation, because wages have been sticky and because of some of the lag effects, it's just taking longer to get prices and inflation back down to the Fed's target, back down to 2%.
Yeah.
And so if the Fed can't cut rates because inflation is too high, then they're not in a position to provide accommodation to an economy that's slowing. That's why the bond market, that's why the long end is rallying. That's why we're seeing flatteners. So it's the front end can't really move down because the Fed is unable to cut quickly because of all the uncertainty and because of the inflation. But the long end is starting to pick up on the fact that growth is deteriorating because of this uncertainty. So I think that's what our clients and
and this chart, this is what you were talking about before, is services PMI relative to inflation that bounced in the PPI and CPI levels this week. And also, if you look at the regional Fed data, that's been really regional Fed, like prices paid.
Prices paid indicators have all been positively
with the Richmond and Philly this week, both up.
Yes, so, for prices, yeah.
Yes,
and part of that's tariffs, right? Part of that's the tariff fears, right? That's some of the front running and some of the tariffs, but it's the reality, right? We don't know, and it's possible that we are going to get 25% tariffs, from Trump in order to help plug a hole in the budget. It seems like Bessent and China finance minister had some conversations this morning, and it didn't seem like those went particularly well. It seemed like some icy comments out of both sides in the readout. So I suspect we are going to get a ratcheting up of tariffs from China. We know at the end of this month, Mexico and Canada again are on the clock, right? Are we going to get those tariffs coming back, or are they going to get extended for another 30 days? That creates uncertainty. So that's leading to fear in the corporate part of the economy, saying if tariffs are going up, we're raising prices, and that's showing up in the prices paid indicators of these regional PMIs.
Yeah, and Stan Druckenmiller always said you can't kill, you cannot kill inflation without meaningful unemployment, because it gets under the seat cushions, it gets under the carpets. You just can't kill it, and so, like you said, it lingers around and stays around. One of the things we're noticing this week, there's been a really nasty capitulation in the uranium space, but not a category 5. We have our scale, we have our capitulation model. We developed it in 2010. The late Larry McCarthy was fantastic. It's one of the best models in the world in measuring capitulation. So we've been long Cameco for a lot of years, since 2020. We exited the position in the summer there, that green dot. Now we took a position today. And so there's been a pretty nasty, I think what's happening with the Ukraine war, Craig, is the Ukraine war has stressed Russia, and the Russian economy slowing down has stressed the region. There's this mysterious supply, Kazakhstan, that's come on the market in the uranium space. And, the thing about the uranium space, it's a high beta sector, so it moves much more violently than the market. And that's why you have to trade around it, hold a core position for 3 to 5 years, but trade around it because the moves are so violent in your high beta sectors. And we think right now this is another opportunity, which we've had multiple opportunities in uranium since 2020. We've been buying the dips. As people know, we've been very vocal in this space. In our book, How to Listen to Market Speak, there's a whole chapter on artificial intelligence. The demand for power is going to be spectacular the next 10 years. And then when it comes to copper, you've got the Ukraine rebuild. Think of all the businesses and structures that have to be built in the Ukraine, in Gaza, in Los Angeles, right? And then you have all the data centers that need power, and that need copper. And then you have the power grid in the United States. So we're starting to look at copper again on the bullish side. As you get this slowdown scare in the economy, you're going to have a good buying opportunity in copper.
Yeah, I think we're looking to transition. We think folks are looking to transition portfolios from the big tech space into the hard asset space as we move through this year, as the dollar tops out and starts to roll back over, which is part of the Trump agenda.
Yeah, let's bring up that dollar chart.
We need to have a weaker dollar in order to bring back manufacturing, in order to improve our trade balances. And so the ultimate destination is going to be a weaker dollar. The transition to that, could be choppy. And so I think near term, we are concerned about the growth deceleration. And we have some hedges on it. We've been selling down some longs in order to take that into account. But I think as we push through this, area, the hard asset trade, gold for sure, we've been talking about ad nauseum for a while. But uranium, copper, aluminum, steel, these areas, iron ore, are places that we are sprinkling our into now and want to be, getting towards full positions into a, more of a cathartic sell-off if that's what we get over the course of the next, 2 to 6 weeks here on this uncertainty.
And that's the thing. The thing about this for commodities, which should be supported, is if this is a growth slowdown, which it looks like it is, and like I said, the transports are telling you that, oil's telling you that, bonds are telling you that. Everybody, like you said, was on the kind of the bullish dollar story. Bissett was out there meeting with all these different hedge funds in September, October. It's well telegraphed on the tariffs, but then there's this other side to tariffs, and that's the economic slowdown. And so what clients are looking at now is if you're going from, if the probability of a hard landing is going from 1% to say 10%, which is because like 2 weeks ago, the probability of a hard landing with the Bank of America survey reached the lowest levels in a long time. And the Bank of America surveys asset managers. And so I think what's happening is you're going from the probability of a hard landing, 1%, probably to 10 to 15, back to 20. Back in the end of 22, we were at a 38% probability of a hard landing. And as you can see here, when that probability rises, the dollar rolls over. That's going to be supportive of commodities. But the softening of the economy is going to be also very difficult for commodities too, but creates a buying opportunity because that weaker dollar will be supportive of a lot of different commodity names.
Yeah. So that it's about the timing, right? I think it's near term. We are concerned. We've been raising cash, have some hedges on, concerned about the uncertainty and the growth deceleration that's coming, versus expectations. And then as we transition and we get some more clarity from Trump, whatever that may be, right? We just need to see the clarity. We need to see the budget pass. We need to understand what the tariff regime looks like. We need to understand the immigration regime. And then from there, businesses do seem like they're going to get more confident about tax cuts, about the deregulation, and spending money and investing back in America again. And that's the theme. That's the larger theme for the Trump term that we think really sets up well. And so we want to transition, clients into those types of names. But first things first.
And that's the thing. It's expectations were so high, maybe 4 weeks ago. And so it doesn't take much to really impact the market when expectations are that high. I mean, just look at S&P earnings, right? S&P earnings are starting to roll over. There's a lot of data out the last couple of weeks, and earnings are rolling over relative to expectations on Japan's side. Think of what happened since September, right? This is really important for investors because since September, the dollar ripped violently, but gas and oil were also higher, especially natural gas. So companies that import energy, and we've been saying this over and over again in the turning point and the one idea, but when you have countries like Japan that are big energy importers and the dollar's stronger and energy's up against them, it's a double whammy impact on inflation. So you've got this inflation data in Japan that's now higher than the United States. I mean, now this is important because this was your global bond yield anchor for the long time. This was supposed to be the deflation, scary monster was Japan. And at one point in 2020, 21, it looked like Japan was going to take us all into this deflationary spiral. And now with the dollar strength over the last couple of months, I know we're rolling over now. It's creating this kind of inflation bounce in Japan, and now you've got bond yields in Japan at much higher levels.
Yeah. So it's hard to get global interest rates materially lower quickly when yields in Japan are rising, and then yields in Europe have been starting to rise as well. And if Europe is forced into spending more money on defense, which is something that seems like it's happening, Trump kind of forcing them into raising their defense budgets to 5% of GDP from NATO perspective. I mean, that's going to necessitate increased borrowings in Europe. How's that going to get paid for? Probably going to need higher yields kind of globally. And so the stability of the bond in a portfolio is waning. And we've been advocating kind of, less exposure to fixed income and long duration fixed income, more exposure to hard assets and commodities that could benefit in this inflationary environment, which we see here and, accelerating into the second half and into 2026.
And that's the thing. American exceptionalism, Craig, at the end of the day, has been driven by deficit spending. We did almost $2 trillion of deficit spending last year. That's 2 or 3 standard deviations greater than all of the developed world, right, combined, right? So American exceptionalism has been driven by massive, massive deficit spending, right? And now you're coming into a period where the United States, through DOGE or through just a fiscal cliff in the United States, because don't forget, Biden spent in the first quarter $800 billion additional on top of last year's 1.9 trillion, right? So Trump gets forced into this, like, and that's, I think, what Steve Cohen's getting at 0.72. He's talking about this contraction in the second half, because all of a sudden, all a fiscal cliff means is if you go from, $1.92 trillion deficits and you have to cut that by 500 billion, and Doge and Musk are promising that gets you a very sharp economic contraction, because you're going from 90 miles an hour fiscal to like 10 miles an hour, and that rate of change. And from what I hear, Nigel Farage, he's an old time friend. When you talk to people that are close to Trump, they want as much pain away from the midterms as possible. So I think the market's starting to sniff this out. They want the pain. They're going to have to take the pains at some point on inflation, on tariffs, on trying to kill inflation, trying to put forth the tariffs. They need that tariff revenue, and they want to get into this fiscal discipline. They want to keep that as far away, Craig, as far away from the midterms, which is November 2026, as possible, and especially, obviously, the presidential election 28.
Yeah, no, I think that's exactly right. So we're in the budget process is crucial to that. I mean, Bessent has been out saying the scorecard for the administration is the 10-year yield. The way to get the 10-year yield lower, which drives down borrowing costs for all Americans, is to get inflation under control. And the way to get inflation under control is through budget deficit reduction, and that is spending cuts. And so the question is, will Republicans agree on a bill that allows for tax cuts and the extension of the tax cuts, and allows for all the other goodies that Trump wants, paid for with real spending reductions? And if that's the case, that's going to be great. That's going to be a great environment for America, for the 10-year, for everything, and for inflation. But if not, if folks are weak and they don't want to do these spending cuts, I think the bond market is going to be very upset by that. It'll be a red flag on the administration scorecard, and throws into question how serious these guys are about bringing inflation down, for this year into next year. And Trump was elected on bringing down inflation. So if real Americans, if his constituents are not feeling that improvement in inflation, in real inflation, then, it could bode poorly for the Republican setup for next year. I think they got to get this under control now.
Well, thanks everyone for joining us. What we try to do every week, reach out to Tatiana at thebeartrapsreport.com to get into our Discord room, if you're on Bloomberg, reach out to us. We want to have you be part of that conversation. Each week on Friday, we're kind of recapping the intelligence gathering that we're working with the different asset managers around the world. What did we see this week? Craig, another great week. We'll talk to you next Friday, okay?
Thanks, Larry. Take care.
Thanks. All the best.